So let me ask you a few more granular questions about the whole consumption piece. Let's start from the top, the ones which are not seen as rural focused but are very expensive. They've been underperforming over the last few quarters. The names, the expensive ones like Asian Paints and Pidilite and Havells. Do you see further room for compression of their multiples, or have they compressed enough?
So let me take a step back and let's try and understand what are the things happening. I mean, there are two big trends happening in the market today. One is that obviously we are no longer in a low interest rate environment and easy liquidity environment, which had led to these valuations going up much more than the earnings growth rate. The stock prices went up much more than the earnings growth rate. So there is a valuation discipline coming back into the market. Let me just reemphasize that word, valuation discipline. It doesn't mean that every expensive stock is doing badly, but discipline is definitely coming back. And the second thing which is happening is that we are seeing a revival in the cyclical parts of the economy, which is credit growth, investment cycle, real estate, manufacturing. So, ultimately, it's a zero-sum game. One of the reasons why some of these stocks or sectors became expensive was, apart from low interest rates, was also because there were lack of alternatives, because the cyclical part of the economy was not doing well. Now that that part of the economy has also started firing after almost a lost decade, we are seeing a dual impact on the, let's say, the defensive, high quality, high growth, high P kind of stocks, which are coming under pressure from both aspects, high interest rates as well as the alternatives which are now available in the market to really generate alpha.
No, fair point. But has this trade played itself out mostly, or do you think there is more to go?
Oh, I think it can be a beginning of a fairly long period of time correction or valuation discipline to keep coming back and hurting some of these stocks, especially the stocks or companies which are not able to keep pace with the earning expectations which are out there. In some of these cases is still very high. The growth expectations can still be very high. So any minor disappointments pre 2021 used to go unnoticed if it was a high quality, high growth stock. Not anymore. So I think the room for error has reduced, and the margin of safety, which was never there, but margin of safety today gets punished if you're not able to keep pace with growth. So look, India is a growth market, so growth will always get some premium. Let's not make any mistake about it. And we also look for growth when we invest. But if the valuations have gone much beyond the growth expectations, or if quality has got a premium which cannot be justified mathematically beyond a point, I think that process can go on for a fair bit long. Remember that the reverse has happened over the last 7, 10 years, and right now we are only 1 year into this process of what I call as valuation discipline coming back into the market, and we could just be beginning in the beginning of that process.
What about the more rural focused part of the consumption basket? The names like Relaxo and, the Daburs of the world. Would you be more circumspect given what you just said about the monsoons for the next few quarters?
Yes, I think in the rural economy, as I mentioned, at the margin, the monsoon news flow is not great news for sure. So one will have to evaluate these the rural economy leveraged companies or companies which are too dependent on rural economy to fire. We'll have to look at it from that angle. But look, I think we've had these warnings. This is still very, very early in the process of trying to call out monsoons. As you know, with monsoons in India, I think the average numbers also can be high and the spatial distribution can be bad. So, it's very, very difficult in a country like India to generalize and paint with a very broad brush. So we will have to take company specific calls, frankly, because even in consumer companies, there are companies which have been hit not only by top line slowdown but also due to margin pressure. In some cases, the margin pressure today may not be as bad as it was last 1 or 2 years. So really, for consumption as a theme, it is becoming extremely stock specific, bottom up kind of a market. We are no longer trying to play consumption as a theme because there are multiple things happening in the economy today. Interest rates, input costs, rural economy in terms of the monsoons, etc. So it becomes a very bottom up market, and not just for consumption. This is in general true for the markets per se, but more for consumption today.
What you said about valuations compressing, valuation discipline coming back, if you were to extrapolate that question to the broader market, would you say India's challenge today is more earnings related or more valuation related, given that we've seen some semblance of correction over the last few weeks?
Yes, that's a very good question. I think the problem today, or the let's say the process today, which we are going through, is seems more like a valuation problem. As far as the earnings growth rate is concerned, the composition might change. So we might have banks and capital goods and industrials doing better. Consumption may not be doing so well. IT might just hold on. Pharma may not be that good. So overall, it could be a trajectory which could be, it could be either 12% growth rate or 15, 16% growth rate. We are talking in that kind of range. As far as valuations are concerned, till a few months back or till 2, 3 months back, we were at pretty higher end of the valuation premium to other emerging markets. Our valuation premium to other emerging markets had reached 85 to 90%, if I'm not mistaken, in the month of November, December. Now that's down to 65% today, thanks to other markets doing well, and to small correction which we have had, and time-based correction as well as the small correction we have. So we are now at a 65% valuation premium to the MSCI Emerging Market Index, which is not the same as what we have traded in the last 10 years, which has been in the range of 45-50%. So you can argue we are still a little bit on the higher side, but the excess which was there in November, December of 85-90% premium, that excess is definitely gone. And from here on, obviously, earnings become important, and also how the other markets do become important. So let's not forget that one of the reasons why this valuation premium went up to the high levels of 80-90% is also because China did not do well. Other emerging markets, which are more linked to the US and European markets, declined much, much more, and India held steady. So all we had to do was hold steady, and our premium kept on expanding. And therefore, what happens to this premium is not just a function of our earnings growth rate. It's also a function of what happens in China, how quick is their unlocking, and how much more money goes there. Those are the questions which I think will drive that premium. As far as absolute valuations are concerned, we are coming to a reasonable level now. I mean, if you look at fiscal 24 earnings, we will now be trading at 17 and a half times P. This I'm talking about Nifty 50. So, give or take 5%, we are there. We are there at a fair valuation. So from here on, the confidence level is a little higher that at least our, equity returns should be tracking the earnings growth rate and not really lagging the earnings growth rate, which was the case in November, December.
If you like the video, do like, comment, share and subscribe.